So I want to welcome everybody to the Great Public Bank Debate. And I want to emphasize that this is not a winner-loser debate. This is really a chance to talk about the merits and the concerns about public banking and sort of tease these things out as a part of the debate. And, you know, some people may not know what a public bank is, so I just want to say a few things about it first before we jump right in to the debate itself. So a public bank is a regular bank, and the difference is it's 100% owned by the people through their local or state government. And that's in contrast to most banks we know, which are private banks, which are owned by shareholders, right? So a public bank is really designed to serve the public good. And a private bank is designed to serve shareholders and to maximize the return for shareholders. And I should really mention that a public bank is different than a credit union, because a credit union, you voluntarily join a credit union, then you're a member of the credit union, but it doesn't serve all of the people in a particular location. So how does it work? All of the revenues from the government go into the bank. And then the bank, of course, has to pay the obligations of the city or the state. But like any bank, those deposits become the basis for being able to make loans many, many times the value of the deposits themselves. Remember that it's not the deposits that are loaned. The loan becomes the deposits become the basis for the loan. So what a public bank does is it then makes loans in order to carry out social purposes in the community or in the state. And whereas a private bank is making loans in order, again, to maximize profits for the shareholders. So right now there's one public bank in all of the United States. There's a lot of public banks around the world, but only one in the US. So does anybody know where?
North Dakota.
North Dakota, that's right. And, you know, I was quite amazed. North Dakota did not seem to me like the most likely place to have a public bank. It was actually established in 1919, and it's really thriving today. So it is this example, when we've seen the meltdown that came through the mortgages and everything, that created a lot of interest around the country in the whole idea of public banking. So here in DC, last fall, we started to look into the idea of a public bank for the District of Columbia. And we've been meeting ever since then. Steve Sausser, who's going to be our moderator today, and I are the co-chairs of this effort. And I have fact sheets back here on the table and a sign-in sheet, and it has our contact information there. So if you haven't picked up one already, please pick one up. So what we're doing really today is exploring the question of, should cities, counties, states actually create public banks? Is this a good idea or not? And so we have two wonderful debaters here. Marc Calabria is a Cato scholar, and he spent 6 years as a senior professional staff of the Senate Banking Committee before you went to Cato, right?
Yes.
And handling issues related to housing, mortgage finance, economics, banking, and insurance. Before this, you were the Deputy Assistant Secretary for Regulatory Affairs at HUD, and you've held positions at Harvard and in the private sector, and on both housing and real estate, and been research associate with the U.S. Census Bureau Center for Economic Studies. You don't look like you could have done all of these things already. I'm really impressed, Mark. And you hold a doctorate in economics from George Mason University, so we're really happy to have you here for this debate. And we have a second Mark for this debate. Yes, with a C and with a K. Marc Armstrong is the Executive Director of the Public Banking Institute. He's here from California. We're really glad that you could make the trip here. And he's a business development and communications consultant. And you got involved in public banking after reading a book by Ellen Brown, The Web of Debt. And this really changed your professional life, it seems to me, because you founded the Public Banking Institute then.
With a lot of other people.
With a lot of other people. And there's now been 17 bills that have been introduced in the state houses around the country in the last 18 months that have to do with public banking. So we think this is a very exciting start. But before that, you worked with IBM Finance and in the wholesale banking divisions, both for Bank of America and Wells Fargo. Is that right?
That's right.
And so they were the primary customers that you were working with. This is, you bring quite a background to the discussion of public banking today. So you have an MBA from the Anderson School of Business at UCLA in Information Systems and Organizational Behavior. So we're really delighted to have both of you here to have this debate and conversation about public banking. And again, Steve Saucer is our moderator, and Steve and I co-chair the Public Partnership Working Group for DC. And I think in the debate you'll understand more why we use the term partnership when we talk about our effort. So Steve, I'm going to turn this over to you now.
So welcome and thank you for joining us for this great public banking debate. We have a format that's designed to give time for each participant to answer a series of questions that we've posed. There'll be a response by the other person and then a very short response by the initial person who's being asked the question. And we have a mix of hardball and softball questions, so we're not trying to nail anybody. And we just want to explore these issues, and we also encourage you to take note of issues that maybe we haven't explored fully in our questions. So if there are things that you'd like to ask at the end, we'll have about probably an hour's worth of conversation with our questions, and at the end we'll leave time for you to pose your own questions. So if things come up during the discussion that you don't feel are answered, please take note of them, and we'll find time at the end to allow you to pose your own questions. So I'd like to start out by asking each debater to make an opening statement, and I'd like to ask Marc Armstrong to take the first 2 minutes, and then we'll pass it on to Mark Calabria.
Okay, great. Thank you, Steve. Thank you, Ruth. And thank you, Mark, for joining us in this debate. We did start the great public banking debate because the Public Banking Institute felt that it was important to bring into the public discourse this topic and to begin to have a public discussion about it. And there are pros and cons, and I hope we explore them thoroughly. The main reasons why I'm an advocate for public banking are as follows. State and any sort of local government face a series of very hard choices when they have revenue shortfalls. They either have to raise taxes, which is not on the table. They have to cut services, which is painful for a lot of people, and that's the austerity approach that governments are taking worldwide. Or finally, the other option is to sell off granny silverware, to sell off the public assets to typically the 1%. And so, none of those are very good alternatives. And so public banking is a revenue source for these governments. And that's what's been proven to be true in North Dakota. Over the last 10 years, nearly $400 million has been contributed to the state budget, in addition to a number of $1 million going back to the state bank to recapitalize it or to extend the capitalization so they can make even more loans. So it's a revenue source is one. The second reason is that it saves money. In California, we have a Bay Bridge retrofit. It's costing $6 billion to retrofit a bridge that originally cost about $80 million in the mid-1930s. So the $6 billion is just for services as well as for materials. And it's another $6 billion in financing, interest and fees. And if the state of California had a public depository bank, what they're doing is using the infrastructure bank in California to finance that. But if we had a depository bank, all of the interest charges, whatever they would be returned as revenue to the state of California. And right now, all those interest charges are paid to private investors typically. So in addition to being a revenue source, it's also a cost reduction. It could be a cost reduction effort. And finally, the main benefit for a public bank is simply that it injects liquidity into the economy. The state of North Dakota has put $3 billion as loans into their economy. And these loans, as Thomas Jefferson says, money is basically the circulating medium. It enables economic transactions. And so they're not starved for credit in North Dakota because they've got $3 billion of liquidity, which is affordable. Some of the commercial loans are as low as 1%, very low-cost student loans. Student loans are their largest portion of the portfolio. And so it supports the people with affordable interest loans. So those are the three main reasons. Thank you.
Let me preface with, I think somewhat this has been advertised as public banks versus Wall Street, and to be very clear, if you came here to hear someone defend Wall Street, you can leave now. I think our current system is absolutely broken. Some of the distinction I will take is when I look at the slides that Mark has put up, what's public versus private, I actually think the choices are three, because I don't think our so-called private banking system is private at all. When you look at things like dependent on bailouts, that's not private. So I would say what we have is a purely state model as an option. We have a mixed model. I would think of it as a corporatist model, maybe a crony model, but you can also think of it as, some of my friends might call it a public-private partnership model, whatever have you. And then I would see a third model, which I would see, invoking what Ruth mentioned, sort of like credit union, a voluntary consensual model that is not set up by government, that is set up by voluntary interaction of individuals. That would be a free banking model. To go back to some of the points that Mark raised, setting aside the issue, I think the first question should be asked, what is the problem you're trying to solve? And to some extent, if the problem is lack of credit or not enough credit, personally, I'm of the view we just came through a massive credit bubble. I would argue even with a lot of the defaults and pay down of mortgages that our economy is still over-leveraged. So as a general proposition, the economists tend to usually, the usual argument for having a public provision of a good is that that good is not provided enough by the private sector. And I think some of the argument here is that we don't have enough credit. I would argue we have too much credit in the economy. We're too dependent on debt in our economy. So as a general matter, I don't think we need to have more debt in the economy. The question should maybe have more equity in the economy. I also tend to think, I'm certainly very sympathetic and understand that there are funding pressures, not just at the federal level, but at the state and local. But the revenue question, what concerns me is quite often is that finance is used by government often to hide the cost rather than be transparent about the cost. Let's take for issue Freddie and Fannie. We've paid $180 billion so far in counting to bail out Freddie and Fannie. We were told for years that this would never cost us a dime. We were told for years this is expanding homeownership and all sorts of great things. I'll set aside the fact that the money we use for Freddie and Fannie, we could have bought every rental. We could have provided every renter in the country with a $5,000 down payment. We could have bought every homeless person in America a house with what we bailed out Freddie and Fannie. But my point being is that if you want to help people, if you want to provide assistance, raise their taxes and spend it. That is transparent, it's honest, it's accountable. And so I'm very concerned that the public banking model, both as we have a mix at the federal level, and we've had it at the federal level, the first and second bank in the United States, over 100 some years ago, a Fannie model. I think these things are less transparent than actually raising and spending money. I also think North Dakota is a relatively unique model. They have been running surpluses. I don't know how many other state governments are running surpluses. Part of the North Dakota model is contingent upon you run surpluses, they're in the bank, they're out to lend. In any other state like California, you're essentially bring the money in and you're spending as much as you bring it. So I'm not sure that I think that's a sustainable model. I will note as well, as Mark mentioned, the largest consumer component, because it's also important to keep in mind that the majority of lending by the Bank of North Dakota is actually to business. For instance, fossil fuel industry gets a whole lot of lending from the Bank of North Dakota. So if you believe fossil fuels need to be subsidized more, that's a model that works in that regard. Pretty much 90% of the student lending is federally guaranteed. Over 80% of the residential lending by the Bank of North Dakota is federally guaranteed. So to a very large extent, the Bank of North Dakota has managed to be safe because all of the risk is transferred to us here in Washington. So again, maybe the model is you don't do that and the risk is actually staying in North Dakota. It remembers a quip that I heard a North Dakota politician say one time that I think describes it pretty well. He said, "We send Republicans to the state capitol to keep an eye on our money. We send Democrats to Washington to get other people's money." That to me is not necessarily a compelling model of government to me. And I would say, as just an aside, we can get back into this a little bit more, and it goes back to my differences in three. Part of the issue is really how much do you believe local government reflects consent of the people? I think we can probably all agree, if we're not quite skeptical, that Washington doesn't always reflect the consent of the people. I'm quite skeptical, and I'm a resident of District of Columbia, so maybe I'm a little jaded. But I'm not. Part of this is going to be, if these loans are going to go for public purposes. Again, you can look at the Bank of North Dakota; its biggest lending sector is to fossil fuels. So again, how much do these actually reflect the consent of the people, rather than are used for particular constituencies and interests within the state that happen to have an influence over this? And again, I would say, as an aside, if you ever have the opportunity to go back and read President Andrew Jackson's veto of the Second Bank of the United States, wonderful statement of a president's clear constitutional principles, where he looked at this monopoly as benefiting the various special interests and constituencies in corporate America, and vetoed it on those reasons. And again, I think many of those concerns and skepticism are still legitimate today. And I apologize, I'm sure I went more than 2 minutes.
No, that's great. Thank you very much for both of your statements. So the first question is going back to you, Mark, with a question about whether the government should be in the banking business at all.
Yeah, again, I'll reiterate. The economist in me is, what is the market failure? What's the problem here that's not being provided? I'll repeat, I think there's a tremendous amount of credit in the economy. I think there are some availability issues now, but I also think you need to separate out issues from we're in a recession versus trend issues of what the credit will be. Certainly in 2005, 2006, anybody who could fog a mirror got a loan. That to me is an argument for having too much credit in the economy. I also worry as an economist that if you don't get the prices right, people make bad decisions. And so it's important that the interest rate is a price not only of time, but it's also a price of risk. And so if you force an interest rate lower than what would be reflected by the risk, people take more risk and we get more trouble. So I don't really look at this as saying, how do I make sure that California, or how do I make sure this mortgage borrower can get a lower rate? To me, what you need to make sure is, how does the rate they get reflect the risk that they represent, so that they themselves make good decisions? So I think ownership is an important issue, but I think it's a secondary issue to how do you get the incentives for individuals right so that they make the right conclusions and the right discussions. And again, I'll go back and just end on a very philosophical note. At the Cato Institute, we are libertarian. I look at my objective in public policy as quite simply, how do I get to a world where I minimize the use of force and coercion as a social organizing principle? And in a public bank, I am being coerced, directly or indirectly, to either lend to another person or to cover the losses of another person. So again, some of this is not as much ownership structure as it is the process voluntary? Is it consensual, or is it a process that's built upon force?
Great.
Thank you. Mark?
Okay, thanks.
Rebuttal?
Yeah, I want to talk about the problem we're trying to solve, but let me address the risk first, since you ended on that. A lot of folks think that there is coercion involved, and yes, it is a public institution, and public funds are being used to capitalize the bank as well as serve as the deposit base. And so, if you call that coercion, you can do that. But it's also true that these are just people coming together and in a representative body deciding what's best for the good of the people. And part of that in North Dakota is that the average loan write-off rate for private banks in North Dakota in 2010 was 0.87%. That means they wrote off 0.87% of their outstanding loans due to bad loans. Bank of North Dakota, it was 0.22%. So far less risk associated with this model. So you're actually not putting public funds more at risk using a risky, quote-unquote, banking model. There are procedures in place, and the whole model is set up to minimize the risk for the public. Going back to the problem we're solving, the problem we're solving is obvious. We have not only a credit crisis, but that's led to all sorts of secondary problems, including joblessness. 13 million people unemployed in this country, another 7 or 10 million people who are underemployed. And that's a huge problem for a lot of people, and that's at the root of the foreclosure crisis. One of the problems, I know banks are involved in that too. So, but certainly if we all had jobs and well-paying jobs, we would not have the level of severity with this foreclosure crisis. And that's the core problem that I think a public bank solves, in that it creates this pool of liquidity, pool of money, which is used to fund businesses in the state, whether they're for fossil fuel or sustainable ag, as they would likely be in California, or some sort of high-tech manufacturing or whatever. So that's it.
Okay, and 30-second response, if you'd like.
Then we can move on to the next question and
Okay.
come back. I will just note very quickly, North Dakota did not have a housing bubble, so certainly one would expect that institutions there would perform a little differently than institutions in California, so there certainly is a difference there. I'll also note, the Federal Reserve is essentially keeping interest rates at zero today, so you can get credit today. It's quite cheap. I'll end by saying, my reflection of the last 10 years, or probably not the last 100 years, is that throwing cheap credit is not a sustainable solution to social problems.
Thank you. And Marc Armstrong, a question for you. Should public money be deposited in private banks?
Okay. So right now, 49 of the 50 states essentially take their public monies, whether it's a quarter that's deposited in your parking meter, or for municipal revenue, or it's going to be state income tax revenue or residential property tax. The vast majority of that money is deposited in New York Wall Street banks, which are private and which use it for their own benefit. The money can be under the control of the state treasurer, and state treasurers will say that that's under their control. But the fact of the matter is that a depository bank is set up so that when there's a deposit, which from a bank's point of view is a liability, they get to create credit from it. And that credit is used to fund loans historically, but with the repeal of Glass-Steagall, more and more money is going into equities. And some of the equities that are being bought are bought overseas in manufacturers or business who compete with the very same people who paid those state income taxes in the first place. So our money is essentially being used against us. And our proposition is simply to bring that money back home, put it into a public institution, so the credit that's generated is then used for the good of the people.
And the response?
I'm probably going to say this several times on other questions, but it depends. And in many of these things, the devil's going to be in the details. I think one approach you have to keep in mind is that for putting the public deposits, one of the things you want to do is try to maximize the deposit interest rate you get paid back. Because, of course, that affects how much other revenue you need to raise. The more you get paid on interest in public deposits, the more revenue the local government has and the more public goods, or the quality public goods they can provide. So to the extent that if you put it in a public bank, if they're paying a lower interest rate than you get otherwise, then you're having to raise revenue elsewhere to offset that. Again, so it would depend who pays. I would put something as an aside. We're maybe, I don't want, this is not a conversation necessarily about free trade, but I will emphasize, I don't have a problem with banks funding development overseas. I think Americans, we need to recognize we are very lucky. We do not know what poverty looks like if you want to travel the rest of the world and really see poverty. So I don't have a problem with American banks investing in developing emerging countries to try to help those countries develop and maybe be somewhat richer. So again, I'm not an anti-trade person. I think we need to open up and embrace the rest of the world. And I don't worry as much about competing industries, because at the end of the day, if the choice is protecting American industries versus allowing American consumers to get better and cheaper products, I'm going to side with the American consumers. But I will back to the next question.
And do you have a final response?
Yeah, just a quick response. Just a point of clarification. When a public bank is established in a state, for instance, the capital comes from the state revenues as well as all the state revenues are deposited in that bank. So you can set it up so that there's no deposit coming from the general public. Individuals like all of us could not put money in that bank. That would typically be considered a wholesale bank. It's not providing retail services. And its objective is simply to create credit, affordable credit, which is then lent out through lending programs. And so the money that it receives back in interest is then returned to the state coffers. So you would not have a situation where you have individuals deciding whether or not they're going to put their money into that bank. because it's not a retail bank.
Okay. Question for Marc Calabria. With the 2008 financial crisis, haven't we exposed a concentrated risk within the Wall Street banking system? Given this, why should we trust them? And maybe this is not exactly, you're not going to defend them, but...
I can say I don't trust them. I was very vocal 2008 that I was against the bailouts then. I think it's absurd that this is the third time we bailed out Citibank in its history. This is actually the second time we bailed out Fannie Mae. So I think part of the learning process, maybe I should step back and make a broader generalized point, which is I tend to think of all human institutions, whether it's the church, whether it's the state, whether it's a corporation, whether it's a family, are kind of error correction mechanisms, because let's admit it to ourselves. We all screw up pretty regularly. I know I do. And so the point is what sort of social institutions help you correct those errors more effectively, more quickly. And one of the error correction mechanisms is with an institutional framework that doesn't work, like arguably Citibank, continues to fail. It goes out of business and those resources are allocated to others who don't continue to screw up. And so one of my concerns with the public bank is it never goes out of business. And I think this is, unfortunately, we need to be a recognition of deciding what works in terms of other programs and what does not work. And so, again, I don't necessarily trust Wall Street. I think that there's way too much interconnection. I think there's a huge revolving door between Treasury and the Federal Reserve and Wall Street that I think we need to be concerned about. And again, my point would be, I'm not in favor. I mean, if you told me my only options were public bank or corporatist banking system today, I might be very sympathetic to the public banking system. But I'm not ready to quite give up on having a free, consensual banking system that is not having the government and Wall Street hand in hand. So again, I don't trust them and want to eliminate their ability to continue to pick my pocket.
So I like your point about there is a self-correcting mechanism in place with any institution. And I want to make the point that a public bank network, a network of state and county-owned public banks, is simply an alternative to the existing private bank network. And so what we're advocating is to give this kind of choice to people, and particularly to legislators who really need an alternative, as opposed to raising taxes or cutting services or selling public assets. A revenue-generating mechanism actually may be a good idea. And so that's what we're proposing. And there actually is a possibility that public banks, I think there has been some public banks that have gone out of business. It's not proven to be the case, of course, in North Dakota, but I think the self-correcting mechanism would come into play. Let's say the loan write-off rate, goes up to 2%, 3%. All of a sudden, there's going to be great concern about the quality of loans in the loan portfolio, and that would be aired, and there would be some sort of impact. So I think that's what would happen to a public bank.
And final quick response?
Again, as I mentioned, every social institution is sort of an error correction. It's just which ones are quicker and which more relative. And again, I'll use the example of we are 3.5 years later and we're still putting money into Freddie and Fannie without resolving that. And this is the second time in history we bailed out Fannie. So we don't seem to learn in that instance. And as I mentioned, it's the third time we've bailed out Citibank. So you could argue we are certainly trying to correct those errors. I just am not convinced that we necessarily are doing them very quickly or very effectively.
Great, thank you. A question for Marc Armstrong. Wouldn't the public bank compete with local private banks?
If a public bank were set up to be a retail institution, as is common across the world, that would be the case. So in New Zealand, they have the Kiwi Bank, which is their national public bank, and it's set up in each one of their post offices. So they've solved their postal problem by creating a set of banking services that they provide to people who go to the post office. Something similar is set up in Germany, and then there are plenty of other countries, including Chile, that have public banks. And so some are retail, some are more wholesale. The model we have in the States is a wholesale bank, and as a wholesale bank, there are only about 25 wholesale banks in the United States, and most of them are owned by very large Wall Street banks. So there's a little competition going on between a public wholesale bank and a private wholesale bank, typically Wall Street banks. But But the fact of the matter is that most community banks are provided additional credit that they can lend out, which they make origination fees on. And so it's a revenue source for community banks, for small private community banks. And so as opposed to competing with them, the Bank of North Dakota actually adds to their bottom line by allowing them to go after larger loans, which they would lose to the Wells Fargos of the world if they had to compete with them. So, thank you.
Again, I'll start with it depends, but let's take a couple of examples. Certainly we've seen in Germany where the Landsbanks, which are the public banks there, bought whole lots of subprime MBS from United States banks and made horrible decisions and have cost the German people a whole lot of money. The Spanish publicly owned savings and loans fueled the housing bubble there and have ended up costing the Spanish government a tremendous amount of money. But the point is, it depends on how it's set up. I want to read something, and I'll recommend. There was a fascinating interview in Mother Jones a couple years ago with the current CEO of the North Dakota Bank. And and I think he echoes something that Mark just said, which is, we were designed and set up to partner with them and not compete with them. So most of the lending we do is participatory in nature. It's originated by a local bank, and we come in and participate in the loan and use some of our programs to share risk about the interest rate. My point with reading this is that, at least as structured, the Bank of North Dakota is not a competitor with private banks. It is a partner. Now, to me, a partner is sometimes a synonym for you providing a subsidy. So the bank does provide subsidies to basically local community banks in North Dakota. We can debate whether that is an efficient provision. I know as well at the federal level, I mean, it's often, I think, in the press made it look like that Fannie Mae competes with Bear Stearns or something like that. That's not actually the case. A fourth of what Fannie Mae bought was from Countrywide, for instance. And so many of these public-private institutions are partners with, and in my opinion, provide massive subsidies to the banking system. And again, I want to emphasize maybe part of the difference is that, and I agree, I mean, Mark sees this as a revenue source for local government. I think it is a revenue source, but my perspective is we should raise revenue as transparently and honestly as possible. If we believe a public purpose is important, then we should be willing to raise taxes to spend it, because the money comes from somewhere. I mean, there is a subsidy inherent, and it's either raised by taxes or it's raised in the lending industry. At the end of the day, I mean, for instance, we're going to have to pay taxes to fill the hole in our financial system. If we had simply appropriated and raised that money and spent it, we'd be in a much better position. So again, my concern is partly if the ultimate objective is just to simply raise revenues, then we should raise those revenues in a more transparent and more open manner.
And final response?
Right, final response is, I want to make sure that everyone understands that the primary reason that PBI, Public Banking Institute, supports and advocates for public banking is because of the nature of banking. It injects $3 billion of new money into the economy. Yes, there's revenue that's raised, and there's that reason to be attracted to a public bank. But the most important thing is that there are plenty of people who think that there's not enough money in this economy. The fact is 95+% of our money is created as debt. And so every dollar in your pocket, every dollar in your checkbook is somebody else's debt that they took out through a loan. And there's not enough of that in our society right now. So to employ people, etc. So it's the liquidity which I would emphasize. And one final thing about talking about public banks that are overseas, it depends. And Chile 3 years ago, in 2009, realized that there was a credit crisis, and instead of taking a austerity approach, they decided to put $500 million in new capital into their bank, which allowed them to make quite a few $billion of additional loans to both large business as well as small business. And it was quite a success. Their lending percentage rate went up quite a bit, and they ended up saving a lot of businesses precisely because they did not view this as a time to cut back, but to loosen the controls and get new money into the economy.
Okay, and for Mark Calabria, would public banks place undue risk on state and local governments?
I think they very much could, and I mean, you could say, again, it depends, but part of my concern is that if you want to do spending and you want to subsidize, you want to favor certain industries, you should do so transparently and directly, and do it in a way that is on budget and that is clear for when people want to go back and look at it. It's very difficult. I mean, I would challenge anybody to look at the Bank of North Dakota and give me a calculation of what the possible contingent liability is. We simply don't know, and it's very hard to calculate those numbers. So my concern is, particularly in an environment where budgetary pressures are there, that the temptation for politicians is simply say, well, I can raise taxes and get unelected and people will be mad at me, or I can do this via financing and nobody will really understand what's going on, and then it'll come back to be paid for some future generation and I won't have to be around to be accountable. So again, I think it reduces accountability of the politicians at the local level. I will say, I would much more prefer public banks at a state and local level than I would at the federal level, because I think that leaves some competition, and me as a taxpayer at a local level could leave if I think that the government is not performing public services adequately, or if I think that, for instance, I love the weather in California, but there's no way that I would move there now because I think that public services are going to continue to decline. And I have the choice of not living there now because of that. So again, I worry that that this is a less transparent way of providing public services that have to be paid one way or another. I mean, we should keep in mind, and maybe this is the most critical distinction between our positions, which is, to what extent does increasing the availability of credit and money in the economy actually run the economy? Obviously, on a very basic level, we save on costs by having cash in our pocket rather than me carrying around 3 chickens so I can trade that to you for a grain of flour. I mean, so again, that makes the economy far more efficient and far more effective. But at the same time, we've seen a Federal Reserve that has thrown a tremendous amount of money in our economy. Commercial banks have $1 trillion in cash on their balance sheets. The question should be, how do we get that money off the bank balance sheets and into the real economy? But again, we've pumped a tremendous amount of liquidity into the system. There's probably been no time in the history of the Federal Reserve where monetary policy has been this loose. So I guess I would question, I'm not really convinced. I mean, I think it contributes in terms of availability of credit to the economy, but I'm not convinced that tremendously increasing credit in this economy would turn us around. And I ultimately feel like we need to get on a firmer foundation of an economy that is not just based on borrow, but is based on productivity, earning, wealth creation, rather than, again, just credit.
Okay, so I'm glad you mentioned wealth creation. So let's. A lot of people in our country believe that wealth is money, and wealth is really the productive capacity of our communities to produce the goods and services that provide for each member of our community. Okay, so that's where our wealth is, and we're unbolting that from our manufacturing floors and shipping that overseas. And so we're really harming our wealth by outsourcing as much as we are. So the way I see that money can be used is very typical for a banker, and that is you make loans for sound investments. And the investments are to create that productive capacity. If you talk with anybody who's involved in sustainable ag or renewable energy, or you go down the list of areas that our economy needs to expand in, simply to catch up with other developed countries, those are all areas that are typically not funded by bank loans. A small business person cannot get a loan certainly for sustainable agricultural type production. And so if we're going to develop the wealth of our country, we need to have a source of affordable loans. There may be plenty of money on the bank balance sheets, but there's not money in the hands of businesses on Main Street. And that's the point I want to make, because that's how you generate wealth, by getting the money in the hands of low-cost credit in the hands of these businesses, so that they can start producing and creating that wealth that we all need.
And final response?
I want to, in addition to the $1 trillion that's on the balance sheets of banks, you have $2 trillion that's on the balance sheets of corporations in America. So at least at larger corporations, there's not a deficit in terms of being able to raise funding. Again, maybe I would say the distinction is, I think Mark has, I would put it, a lot more faith in the decision making of local officials than I do. And again, maybe I'm jaded by living in the District of Columbia, but I would not trust the city council here with a private bank, public bank, quite frankly. And again, that also is a reflection of, I spent a number of years working in the Senate, and part of my experience is I just don't trust, and this is not a partisan statement. I don't trust Republicans, I don't trust Democrats with making these decisions, because my view of what they've done in the credit market is to use the credit market to steer cheap credit to favored constituencies rather than the common good. And so some of this is fundamentally a difference in one's faith in government. I believe if government operates the way that Mark believes it does, I would support his position. But the difference is my experience has been it does not.
Thank you. And Marc Armstrong, I'm going to skip ahead to a question that's along the lines of this discussion. Wouldn't politicians interfere with the operations of a public bank?
Okay, great. Thank you. So the one of the biggest issues with a public bank is what you just brought up, Mark, and that is, do you really trust politicians not to favor a particular industry or individuals or businesses? And what they do in North Dakota is quite significant, because they've got a very important control point in the loan origination process. The only thing that the Bank of North Dakota generates is loan programs. They have these massive pools of credit, which they package into loan programs. And then it's private banks, it is community banks who do the loan origination. So you have community bankers who are deciding who gets to participate, who gets to have one of those loans. So it's private bankers who are still making that decision. And most importantly, because many of these loans that they partner with Bank of North Dakota on, let's say it's a $1 million loan, Bank of North Dakota funds $800,000, the community bank funds $200,000. Well, the group that is first in line for the risk is the community bank. So they're on the hook if that goes south. And another way to say that is Bank of North Dakota is first in line in case there's a problem, and they get to recover as much money as possible. So you've got this built-in control mechanism which actually prohibits legislators from influencing that decision. They're not involved in it.
If I remember correctly, the governing structure of essentially what you would have is the board of directors for the Bank of North Dakota, and again, we both should be careful in that there are pluses and flaws with the Bank of North Dakota, and so I'm not sure that is looked at as the model for all of this, but essentially the governor is essentially the chair of the board of the Bank of North Dakota. That might not be the legislator, but in my experience, governors are just as politically motivated as legislators, sometimes worse so. I would say that you've got a lot of other mechanisms. For instance, you read in the press that Fannie Mae, for instance, has pushed they have required money at Bank of America and Wells and all these other money to give back, and the other banks have taken the first loss. So again, you have some of these mechanisms in place at different levels that, in my opinion, have not turned out necessarily well. One can debate, it's very hard to parse out that the Bank of North Dakota gives loans heavily to the fossil fuel and the ag sector. On one hand, that's a lot of the North Dakota economy, so you certainly would expect that to be a disproportionate share of the portfolio, but on the other hand, it's not clear to me that those aren't necessarily politically influential sectors of that state economy either. So again, I have some concern with that. I want to make a broader point in terms of my distinction between adding a third category, which would be a private banking market that is not influenced by government, which is, in a market that functions and works well, one of the primary constraints upon mismanagement, corruption, fraud, or even simply a bad business model is that people charge you more to lend to you. Your cost of funds should go up. And so that helps to constrain bad decision making because nobody else wants to lend to you. You can look at it in the Bank of North Dakota, there is no funding constraint. As long as there's tax revenue, they put it in there. The cost of funds to the Bank of North Dakota is not influenced by their management style. One of the real perversities, I think, in our system was with Fannie Mae. The more debt they issued, the more corrupt and more ineffective they were, the cheaper it was actually to borrow. There was no discipline on that. And you see that now, the importance, for instance, of too big to fail banks is that Bank of America and Wells and these larger too big to fail banks will be able to borrow at a lower rate than their competitors and help consolidate the industry. in that there is no funding discipline, and let's keep in mind that debt would be 90% plus of their funding. So I think the objective should be ultimately in sort of a bank reform, and this is again an area of agreement, which is we think the current system is broken. I think the objective of fixing the current system is how do you get people who lend money to banks to monitor and discipline and force the banks to behave. We don't have that in the current system, at least for the largest banks. We don't have that in the North Dakota bank system. So my suggestion would be, how do we get there where we bring monitoring and discipline to these institutions? Final response?
I want to repeat that if you are taking on more risk by making loans more affordable, then you would assume that there would be a higher write-off rate, but that's proven to be otherwise with the Bank of North Dakota. So the fact of the matter is that there's something else going on there. I think one of them is one of the reasons why it's so low is because Bank of North Dakota is a public institution. They're really good at regulations, and they are really good at adhering to them. And so you actually have a situation where, because of the Dodd-Frank regulations that have influenced all banking across the country, even though it was originally designed for Wall Street banks, you've got the situation where you've got these very small community banks in rural North Dakota feeling like they're out of compliance because of these regulations, and so they are outsourcing that to the Bank of North Dakota, because the Bank of North Dakota is very good at compliance. So you end up with a situation where you've got a state institution ensuring that the private institution is compliant to federal regulations, which works because there's a very low bank failure rate. There hasn't been a bank that's failed in North Dakota in well over a decade, and the standards are quite high. So it's perplexing.
If I could make a quick point. I mean, any bank is going to be subject to, despite its own mistakes, also the influence of the overall economy. And my recollection is the unemployment rate today in North Dakota is something like 3%.
Less.
And so I would say if our national unemployment rate, which I would love to see it get to 3% someday, was at 3%, I would submit that our banking sector in general would be doing a whole lot better. As I mentioned earlier, there was no housing boom bust in North Dakota. No, this was not Las Vegas. This was not Phoenix. I can only imagine what a Bank of Phoenix would look like, or a Bank of Las Vegas would look like today. And I think the taxpayers in those states would be picking that up. And as I mentioned earlier, in terms of the student lending and the mortgage lending, all of that, vast majority of all of that, 90% is guaranteed by the federal government. So those losses are transferred to us, to all of us, rather than simply borne by the taxpayers in North Dakota. I want to make one correction. The last part of that depended upon bailouts from the Federal Reserve and the FDIC. The Bank of the North Dakota is a member of the Federal Reserve System, does have access to the so-called discount window, and can get funding from the Federal Reserve. So it certainly has some of these same privileges that the rest of the banking system has.
One final point, and that is that one of the reasons why the North Dakota enjoys such a low unemployment rate is because some of their loan programs require that for every $100,000 that's lent, a new job is created in North Dakota. Now, you don't see that with private banks, but a public bank has the latitude to put on a restriction like that for the good of the people. So that's it.
Okay. So the next question is going to Marc Calabria, I think. So public banks exist around the world in both developed and developing countries, and there's only one in the United States. So I'm just wondering what you think of this situation.
Well, I wouldn't. I mean, there are certainly a tremendous amount of differences between the U.S. We actually have a very unique banking system in the U.S. for a variety of reasons. On one hand, this might shock people when they look at the data. We have one of the least concentrating banking sectors in the world, quite actually. You look at Switzerland, and 2 banks are essentially the entire banking system. You look at Britain, and you've got a handful. You go to Canada, and 5-6 banks are the banking system, essentially. So part of the artifact of this is that we are very fragmented. We have over 6,000 banks. And so I'll make another point, which is, if one's concern is that big is bad, small is beautiful, there are thousands of community banks and credit unions in the United States that you can use and should go to if that's what you want. And so that's another option. I would say, if you think that our banking system is bad shape, look at Europe's. I would venture to say that on a mark-to-market, on a true accounting basis of value, the entire French banking system is insolvent today. They just haven't recognized it and admitted it. Germany is about probably the only banking system that even, in Switzerland, about the only banking systems in Europe that even are anywhere near solvency. You're propping up the Greece and Italian and the Spanish banking system with massive amounts of money. In many of these, and again, as I mentioned, in Germany, the Landsbanks there have cost a tremendous amount of money, whereas the private banks in Germany have not. So again, there are things, I'm absolutely willing to say there are things we can learn from the rest of the world, and there are things that we can learn not to do and what we can do. I would look at it in terms of the institutions we have had. We had experiments at the federal level. We had a first and second bank in the United States. Again, I think that they were problematic in many concerns and ended up subsidizing special interests and corporations to an extent that was unwarranted at the time. And again, as I said, I think Andrew Jackson's veto of that was the correct decision. We can argue whether Fannie and Freddie are private or public institutions. Of course, we own them now. So I would say at the end of the day, I think the problem with our banking system is it's too intertwined with the state rather than not enough.
So your point about our having to subsidize all these banks just is indicative of the problem. I mean, we're socializing private enterprise. We're socializing the losses for what should be private enterprise, and yet the profits go to those shareholders. And I think that's one of the core problems here that we have as set up as a structure, whether it's here in the United States or overseas. And I think we need to be realistic about it. If we're going to be socializing the losses, let's just bring it into a public institution and have that function be a role that can be supervised and be transparent and have it be accountable. I mean, because I don't see that third alternative you're talking about. I appreciate
legitimate point.
If that third alternative existed and was clearly something that was beneficial for society, then yeah, that would be great. But the fact of the matter is, I think we're stuck with these two alternatives, and we can live with Wall Street banks and let them do their thing, but let's not socialize their losses. That's our point.
If I can quickly, and I think this is a point of agreement to me. If the choice is we continue to bail out a private sector, or we have a state banking sector, then I would say let's have a state banking sector. What I would say is I'm not giving up yet on getting rid of bailouts. Maybe I'm naive, maybe I'm young, I don't get it, maybe we'll be stuck with it. I will say prior to the 80s, prior to Continental Illinois in 84, we did not bail out big banks. We let them fail at one time. And so I think partly we need a change in the public perception. We need to let our elected officials know that we do not believe that bailouts and subsidies are appropriate. So I'm not giving up on changing that dynamic. At some point, if I recognize that maybe I am stuck with quasi-socialized losses and profits, then we can have a different situation. And so maybe it'll just take me a few more years to accept that, but I'm not going to give up that fight. I will also note I spent a week last summer in lovely Slovenia, and if you've never been there, it's a beautiful country. They have two large public banks that the people there told me they pretty much have to bail out every 10 years. So again, if you look at some of these countries where they've got a very extensive public banking system, it has been very costly. I will certainly be the first to admit that while I complain and worry about corruption here in the United States, it is arguably far less than it is in many other countries. And so there's certainly an argument, so with the exception of Scandinavia, which of course I think they maintain a level of honesty in government that we should certainly strive for. But we're not there yet, in my opinion.
Okay, and let's see, I'm getting lost here. Have you responded to that?
Either way, I think we can.
Okay, so the next question is for Marc Armstrong. How would a public bank stimulate the local economy?
Sorry, what was that?
How would a public bank stimulate the local economy?
So the way it would work, and I've referred to this before, but basically, a local economy is dependent upon injections of money in order to get people to work. I love the analogy. Some people would disagree with this, but I love the analogy of right now we're in a situation where we've got nearly 20 million people sitting around there as if they were on a construction project. They've got the plans, they've got the equipment, they've got the lumber, but they've run out of inches. And so they can't build, so they go home. And that's the source of, that's why they were unemployed. And that's what money is. It's simply a metric which can be used to encourage people to get back to work. And so we need to create more of that metric in the minds of people. And one way to do that is to create loans. It's debt-based, it's not ideal, but it's one way to do it, and you do it without depending upon the federal government. You can do it locally. And that's a really compelling aspect to this. And so by using the state or local tax revenues as a base, you can then create these loans and target expansion in specific sectors of the economy. And that can be a very public dialogue where the community decides what the loan programs are. So, and they do that in North Dakota. Yes, they've decided to fund their fossil fuel. They've also decided to fund manufacturing, a lot of other areas. But they have to fund fossil fuel because the oil doesn't pump itself out of the ground. You gotta get operating loans and buy the equipment to make that happen. So the same similar types of opportunities in Montana, but they don't have a public bank, and so there's not as much development of that resource. Where there are lots of resources in all of our states, whether it's sunshine for renewable energy or agriculture or manufacturing, whatever it may be, and we can use money as a way to develop that resource.
I'll preface with, as an economist, there is actually a fair amount of broad agreement on many things. And for instance, I would say despite, my politics, Paul Krugman and I probably agree on 90% of the stuff. We just spend 90% talking about the 10% we disagree on. And I think that's true in a lot of fields. One of the areas in which there is a fair amount of debate and not a settled degree, that I would put in that 10%, is how much does pushing money, whether it's printing money via the Federal Reserve, whether it's extending credit via other institutions, drive economic activity, or how much essentially does activity drive the demand for money? So essentially, does money drive the economy, or does the economy drive money? And to some extent, I think there's a feedback loop between the two. And so some of my concern would be, I don't think my read of the economic literature leads me to believe that there's a compelling, settled case to say that injecting money from one segment, because let's keep in mind, net debt, and I think this is a hard concept to get, but net debt in the economy is zero. It's always borrowed from one person, who therefore has an asset. The other person has a liability. These things in a balance sheet sense net out. And so the question is, if you're lending from one sector, you're not lending to another sector. You're not necessarily creating money, certainly not in a Federal Reserve style of printing money. You're simply transferring resources from one part of the economy to the other part of the economy. And it's not clear to me, I don't think that in an empirical sense that the evidence is compelling to me. I think this is a fundamentally empirical question. I think it's very hard to answer theoretically. And so, again, I just don't think the evidence is necessarily there. I would say that we've had a tremendous amount of money pumped into the economy via the Federal Reserve, and that doesn't seem, in my opinion, to have moved the needle much in terms of unemployment and rates. Some of this is questions in terms of, is the problem in your economy a lack of demand, because that's often how monetary policy works, or are there structural issues? And I quite frankly think that there are structural issues facing a broader economy.
Response?
Yeah. So the I want to touch on something you just said.
I'm sorry. Structural versus demand.
Yeah. So the bottom question that a lot of communities face is they've got this pool of money, okay, and they put it into private banks, typically Wall Street banks, and the credit that's generated from that, this is not theoretical, this is real, the credit that's generated from that goes overseas or is used by the bank to fund loans elsewhere. It does not return to their community. And so the choice that they have is whether they take their own asset, put it in their own bank, and use the credit that's generated to fund whatever. You could fill in the blank, but let's just stay with commercial loans to fund expansion in the commercial arena with the priorities that they vote on. And that's just a very simple, straightforward decision that they need to make. It's not been in the public discussion because the treasurer typically takes the money, decides for his or herself where that goes, and that's end of discussion. But it is a public asset, and that as a public asset, it should be used for the public good. And I think people are waking up to what banking's all about, and they want to use banking to benefit the people as opposed to benefit the private shareholders?
There's a couple pieces to parse out here, and so let's start with one. I mean, and on a very small level, independent community banks, small credit unions almost do all of their lending in that community.
True.
So the extent is that you don't want your money flowing out of your community. I mean, I'll say myself, it's an open question. I mean, it's a knowable question. We can find out the data and say how much of lending by American banks is overseas. I personally don't think it's a very large amount, but I don't have a problem with that. As I mentioned, most of the rest of the world is substantially poorer than we are and need investment. So I'm more than happy to see some of my deposits go to help farmers in sub-Saharan Africa. I don't have a problem with that. I'd like to see more of it, quite frankly. But that said, if your choice is you want to keep the money in community, independent community small banks and credit unions do that. And also I would say if you want, I mean, I think one of the alternatives we should be looking at are sort of voluntary cooperatives and mutual associations where you join together, you bring your own money in, and you drive, and you can vote on it. I mean, we used to have mutuals were far more common in this country before, and I think unfortunately they've gone out of fashion, but I think that that's one of the alternatives. I would say maybe a very important distinction and assumption between our positions is, you have used the phrase quite often, the public good. Maybe I've been in Washington too long. I'm a bit cynical. I don't necessarily think that the choices of Congress or any one president of any party reflect necessarily the public good. I think they reflect the preferences of the coalitions that have brought them into power. So I guess I would say maybe the difference is I have a little more skeptical view of government. I think if I shared your view of government, I probably would hold the same position. But again, maybe I've been here too long.
Okay, and then a question to Marc Calabria. Why do you think a public bank is working in a conservative Republican state like North Dakota? It sounds like a socialist idea.
Again, this is, I'll say from the reflection of the Cato Institute, we tend to think that Republicans and Democrats are all socialists. They just want to socialize different parts of the economy. They're all looking for their own subsidies. Look at the ag subsidies that go to agribusiness. Republicans love those. So, I don't really, to me, again, they just have different coalitions that back them that they subsidize. So, again, if you look at who the Bank of North Dakota subsidizes, fossil fuels, ag. I would say it might be interesting to come back and redo this in 5 years if we see what happens to the energy sector, because I think one of the reasons that the Bank of North Dakota is looking quite well now is look at what natural gas, coal, oil prices are doing today. I don't have a crystal ball, so I don't know the direction of those commodity markets, but if they crash, I have to believe that the North Dakota Bank is going to be in some trouble. So again, I think it's a misnomer. I certainly do not believe that the Republican Party is the party of free markets, and I don't believe the Democrats are the party of free markets. Again, I believe they seek subsidies for the constituencies that support the various parties.
Yeah, I would agree it's a misnomer as well. I mean, I think that it's a perfect example of where labels break down, because here you have a very conservative state using a very effective tool to serve their needs, and it's a very practical use of what a public bank can be. And so it's hard to put a political label on something that is so ingrained in that culture. It's been around for 93 years, and they make very good use of it. So that's it.
I'll just, maybe it's a little off topic in a sense, but I really think about the founding of all of the great big sort of central bank public banks. I mean, for instance, the Bank of England was a lending bank at one time. And it certainly was founded as a regular bank that lent the bank. The Federal Reserve was meant to be a bank to banks, and to an extent, even the CEO of the Bank of North Dakota describes himself as a banker's bank. But I think if you go back and you look at these institutions, one of the things that concerns me, and maybe this gets back to the public interest question or public good question, the Bank of England, the Bank of France, these things were funded for one fundamental reason at the time, and that was to fund war. And we can have various differences over what the public good is, but I do not believe that these public institutions have a long history of funding things that I think have been good. So sometimes the outcomes have not been pretty ones, and certainly I'm not suspecting that the Bank of North Dakota is going to put together a militia and take over South Dakota anytime soon. But my point is that the preferences that somehow get reflected in these public institutions, and that, in my opinion, have not reflected the common good.
Great. So along that same line, question from Marc Armstrong. If the public bank is run by bankers in order to ensure fiduciary responsibility, how would this be different from any other bank? How would such a public bank reflect the will of the people?
Okay, so the folks at the Bank of North Dakota are very clear that they are professional bankers. And your point is that the governing board is politicians, elected politicians, which is true. But the management team is definitely professional bankers. That's their heritage. And they pride themselves on that. They also have a responsibility to the people. Well, their charter is to serve the interests of the people of North Dakota. And so they're very diligent about adhering to that charter. There was a company, Philadelphia Macaroni, which wanted to open up a plant obviously based in Philadelphia, wanted to open up a plant in Grand Forks, North Dakota. And even though it was an out-of-state business, it was creating jobs in North Dakota, and the Bank of North Dakota funded the loan. And that's kind of an interesting approach they're taking, because they're clearly not favoring North Dakota businesses. They're serving. They felt that it came down on serving the interests of the people, and so they're making risk decisions, etc. And they're obviously, from their rate of the return on equity over the last 3 years being 26, 25, and 19%. They're doing a very good job of making sound investments as well as managing that risk. So, they're not allowing risky political decisions to come into the management of the bank, and that's proven with a number of different factors. It is a state-owned organization, so they're state employees, but they do, as a separate organizational entity, they keep themselves separate from the rest of the state, and that awareness and the charter that they have really makes it happen so that it's run like a professional banker's bank.
Lots of points to that, and one, I think it's interesting that over half of the banks that the Bank of North Dakota banks are originated by a private bank. So there is, it's an open question. Clearly, a lot of the activity they do, the determination of whether that loan is made or not, is made by a private bank. So my point would be I'm not sure that I think the line is as clearly drawn as it is here. I think there's a lot of interaction, a lot of overlap, and in my sense, a lot of that allows the private banks to pass along the risk either indirectly to the federal taxpayer or to the Bank of North Dakota. I will note that they did a lot of, they weren't as reckless as many others, but for instance, 1/10 of the portfolio of the Bank of North Dakota was mortgage-backed securities. They certainly got into that a little bit like other people have, and the bank president himself says they are working through problems in that portfolio. So again, you're susceptible to some of the same sort of crazed herd behavior mania that enters a financial market every 10 to 15 years, it seems. So again, I'm not sure that they're necessarily immune from some of those things in the same way. I would much rather have a divine line. And I'll end by saying, for good or bad, all federal banks, Citibank has a national charter that says it shall serve the public good. It is by law considered an instrumentality of government. That's what the statutes say. So charters are all nice, warm, fuzzy, they sound good, but it's not clear to me that when the rubber meets the road, again, I don't want to beat the point over the head and maybe always fall back to the example, but Fannie Mae was separate from the federal government. They had a charter that said they did public good, and they turned out to be quite expensive in that process.
And final response.
You're using an example of Fannie Mae. That's a national organization. We're trying to focus locally on local communities where there's a much greater sense of accountability. You live next door to the people who are impacted by your decisions on a day-to-day basis, and so I think people are a lot more responsible with regards to having that perspective and framework.
In general, I absolutely agree with that. I tend to like local decision making, and that it has much more interaction with the population, and that you're not as distant. It's worth remembering. Before we had a Federal Deposit Insurance Corporation set up here, we had at least a dozen state deposit insurance funds. They all failed at horrible cost to the taxpayer in those states. So again, which to me is a bizarre course of history. Here, we've tried something in about a dozen different states. It all consistently failed and was expensive. So, hey, let's do it at the federal level. I mean, again, the thinking behind it, I wonder.
Me too.
Okay. So we have a couple of wrap-up questions for the end for Marc Calabria. What do you think are the main challenges, or any other points that you haven't talked about public banks?
Well, again, maybe I will summarize a couple of things, which is how do you ensure accountability? How do you ensure some transparency? Again, I would reiterate, absolutely agree that our current system is broken, and I will also say that I don't think Dodd-Frank Act does anything to really fix it, and quite frankly, I think it entrenches a lot of the things that were broken in the system before. The difference fundamentally is I would rather move to a system where we are trying to bring more market discipline, more accountability, more voluntary consent behind these organizations, rather than having more government involvement, having more political involvement. I'd certainly say that I'm more comfortable having these things at the state and local level where we can experiment and find out. I think that's an important point I should emphasize, and we should emphasize this about all public policy. I think there's too much pretension in public policy that we actually know the right answer ahead of time. I don't. And I think you need to find a way to figure out what the right answer is. And so this has worked in some extent to North Dakota, more or less. I think there have been some problems with it, but I think it's largely been okay there. But that's North Dakota. I mean, I think we'd all probably agree that North Dakota is not really representative of the United States. So certainly, if California wanted to try it, I think that's up to them. I would say as a resident District of Columbia, I would rather not have us try it. But I think having some experimentation, seen in different circumstances, whether it works or not, is the appropriate way to go. Because again, there are a lot of theoretical reasons, both pro and con, and I think ultimately these are questions that only experience are going to really be able to answer for us.
You want to respond to that, or we should do your wrap-up question?
If I could just respond to that, and I just want to reinforce something you said. The notion of experimentation is really important. I think in our society we've lost this willingness to take risk and fail, and it's for the betterment of society. And we have these entrenched structures, organizational and otherwise, systems which we continually reinforce with federal money, and we're just kicking the can down the road. And so I agree with you that we should take on some additional perceived risk, although I don't believe that public banking is additional risk, but at least see how it can work in different states, different communities, and continually improve upon it. And maybe some of it will fail. But what I've learned over the last year plus is our society is extremely entrenched with defending existing systems that clearly don't work. And that's a huge problem we have. And I'm not sure how to break that. I mean,
I wish I had the answer.
Yeah, it's tough.
Okay, and your wrap-up question, Marc Armstrong, what are the main benefits, or anything else you haven't mentioned about benefits of public banks?
Right. Well, we've covered them. Increased revenue, reducing costs, and then the most important thing, to inject affordable credit into the economy. And I think, actually, I want to go into a different area, and that is economic transactions really bind communities together. We've gone through this process where capitalism and organizations have replaced nature with products and replaced community with services. We've replaced the relationships we've had with the services that we now buy and obtain. So we've really fractured our communities. And so I believe that economic transactions are one of the few things that we have to bind us together. Doing deals with one another, or just purchasing things from one another in our local communities. And I see a public bank as reinforcing this sense of community. I mean, if you have the ability to really be involved in how loans are created, the loan portfolio, and they're going to be funding renewable energy, and then you see the renewable energy projects going on in your neighborhood, you end up with this feeling like you can do something about the problems we face. And I think we need to have more of that. So I think that I would add that to the list of benefits.
in your response.
Maybe I'll, and what I think is a little bit, since I started sort of on a philosophical note and saying, I don't have a preference necessarily for market versus non-market transactions. My preference is, again, to try to get us to transactions that minimize, again, the use of force and coercion. I think it's appropriate that we're in a Quaker meeting hall. I mean, many of the decisions in this room are made by consensus. They're not made by, I'm going to take your money to fund this guy's investment, or if he goes bad, you're going to pay it or not. So again, I would prefer that we maybe look back up to a world of cooperative associations, mutuals, where we can truly do come together. And I think that I'm a big fan of local communities, but I think ultimately, local communities have sometimes an ugly discriminatory history, and sometimes you need to be able to leave. So I think, as we would say, the voice participatory aspect is incredibly important, but I also think the individual needs the opportunity to say, I'm getting a raw deal here, and I'm going to move to somewhere else where I'm going to be accepted.
Great. Thank you very much. I actually have a bit of a question and it's kind of a challenge to Mark, because I feel like
with
nothing
Kate?
personal.
No, that's
nothing
quite
personal. But I'm just surprised when you say that your position is based on the libertarianism.
Yes.
That your challenges to the public bank, I don't feel like they really are based on that. They seem to be based a little bit on what I feel like are philosophical point of views that I'm not sure. Like, one thing that I'm baffled about is, and I would like to hear more concrete pros and cons about whether we should establish a public bank in DC or not, and not philosophical debates on microeconomics. Or one of the things you say is we shouldn't have a public bank in DC because there's corruption in DC, for instance. Well, the alternative is Wall Street, and there's corruption. so I'm not really getting it. I don't think that's an argument. The other one is you keep on talking about transparency and accountability. Well, right now my taxes go to a Wall Street bank. I don't know where they spend those taxes. I mean, nobody knows. So where's the accountability there? So I feel like that's also, hold on, it's a long one, but I'm sorry. So I don't see where the accountability is right now. So I'm not sure that that's an argument against the public bank. Hold on.
How about I answer and I'll let you have another question after I answer? We can go back and forth.
Okay.
Because I'll forget. I'm just trying to do this hard.
Or you can take notes.
I'm trying.
Okay. So accountability and Wall Street. So then the other one that I'm not getting is you're talking about coercion. And I don't feel like right now we are coerced. We pay taxes, we pay fines, the money right now goes to Wells Fargo, whatever. I'm not feeling coerced in that public decision of sending our money there. And I don't think we would feel coerced if district government decided to establish a public bank and put the money there. I think what the problem is we don't know where our money goes, what it funds, and we don't really feel like it funds anything. So I really wish we could get more debate on a more concrete, like, here is the argument for a public bank in DC, or this is the argument against it, and I don't want it to be philosophical on the role of government, because we're not going to agree on that. But I think one thing that I feel like I've heard that it's important is, and I would think that somebody on your side of the political spectrum would agree on this, is if there is a way for public government, and that's really taxpayers, to save money on interest, right? That's what I'm getting. Then wouldn't that be smart government? I mean, shouldn't we be for smart government? I mean, if we can save money, right now we're giving all these millions of dollars to Wall Street banks. So, but if you tell me that, and you've got the PhD, I don't have it. So if you tell me that the reason that saving of money with a public bank, then, please don't go back on corruption.
I think we have a choice toward moving toward a free banking system where there are not bailouts, where the taxpayers are not on the hook, where creditors, for the people who lend to banks, take the losses. So I do feel my money was coerced from me to use to bail out AIG, Bear, Fannie. I think all of those things were morally reprehensible. So I feel coerced. I feel violated, quite frankly, that we did those things. But I'm not going to dwell on that. But I do want to say, I think there is an element of coercion here. You and I might never agree on the extent of that, but we'll move beyond. So again, I'm not accepting that as the alternative, which is part of the debate. And if they wanted to invite someone from Wall Street to defend Wall Street, they could have done that. So to me, the question is not Wall Street or public bank. The question is, do I have mutual associations that people join? Do I have credit unions? Do I have independent community banks that are non-Wall Street oriented versus a public bank? Now, I'm not going to dwell on the topic, only to repeat. I've lived in the district over a decade. I think corruption's a real issue here. We don't have to argue it, but I think it's a real issue here. Moving beyond that, to your question directly of saving money. So let's say that you are the public official, and let's assume all of the corruption, all the stuff away. Let's say we bring Mother Teresa back, and she's elected mayor, and she's going to govern Washington, and she's going to do what's right. And let's just say she's decided we've got tax revenue coming in. The Bank of North Dakota is funded almost exclusively by tax revenue that comes in because they need a place to park it. So let's say her decision is, I have this pot of money that I'm going to be sitting on for a short amount of time, because of course at some point it's going to be able to use for public services. What do I do with that money? And as I answered to one of the questions, the decision on saving money should be, do I put it in this entity, which can be public a bank, public A, or a public bank, should be determined by what is the rate of return, what is the deposit money back, what interest is going to be paid on that money. Because if it's higher putting it in a private bank, then that's more revenue the city gets that they don't have to raise elsewhere. So it's an open question, but it's hard for me to see. To me, I think there's a conflict between saying, okay, you're going to pay a higher interest rate back to the city as a public bank, but you're going to charge a lower interest rate on the loans you're making. Those two things are connected. The interest rate that I can get paid back from any bank, private or otherwise, public, is going to be determined by the interest rate that they charge borrowers. So my point is, it's not magic. You can't undercharge and then overpay. You know of no money in that situation. So the point about saving money is ultimately going to be about what is the return you're getting on investing the public's money in that bank. And I don't think it's necessarily proven that you'd be getting a higher return from a public bank. It's an empirical question. It's not philosophical, it's not a theoretical. It's an empirical question of, will that bank give you a higher return? And that higher return has to be offset. Let's keep in mind the Bank of North Dakota is guaranteed by the taxpayer. Whatever we thought about Wall Street, over 300 small banks in this country have failed over the last couple of years. They have not cost you and I a dime. And so the question is also, if the option is a public bank versus a small local community bank, which we have plenty of here in DC, you can go. You don't have to use Bank of America. You don't have to use Wells. There are lots of there are minority-owned community banks in this city that you can use. And so the question would be, do you want to put your money there? Are they going to pay you a higher return? And you're not going to bail them out, because we don't bail out small banks. We have a very unfair system. Big guys get bailouts, little guys go away. Or you put it in a public bank. So I think that to me is going to be the option. So again, I reject that my choice is either Goldman or a public bank. That's not what I'm going to choose from.
So I really appreciate this conversation, and I'm really happy to hear that libertarian philosophy supports cooperatives. We certainly agree on that. So I guess the question here is, we're talking about the economy and how do we build a stronger economy, and what is the role of government? And in my mind, the role of government is to look after the interest of the public, to empower the people. And if we look at other countries like Scandinavian countries that have a very strong social infrastructure, they also have much better, much less wealth inequality, they have better social outcomes, they have better upward mobility. So for me, what I see in the situation that we have now, and I agree that across the board things are broken on so many levels in this country, but let's assume that government is to protect people. A public bank, to me, is an entity that acts in the interest of the people, and so might be willing to make loans to people that need that money so that they can create businesses, so they can have discretionary income, so that they can spend it, and then that builds the economy more. I don't see commercial or private banks as having that same interest in people, in loaning to those smaller businesses. As you said, there's a lot of capital already. We're not seeing it. It's staying up here. So I'm wondering, first for Mark with a C, is that kind of how you see the role of a public bank, that it actually acts in the interest of the people? That's what I'm hearing from you. And I would like to hear from you, because I'm not hearing what is this kind of third way that doesn't exist, and how would that be superior? How would that meet the needs of empowering the people? Because if it's not something that has chartered to protect people, then I'm not sure how. I think it's going to be based on the same scarcity and inequality that we see in a market already. So I guess if that makes sense to you.
I'm interested in hearing it too. Sure. You may be more idealistic than I am. So I think we've gone through a lot of how the public good is served through a public bank. I want to talk a little bit about their approach, and it's very diffuse. I mean, they keep their options open in terms of what sort of loans they make. Sometimes they take on riskier loans, and they also loan at below market rates. I mean, some commercial loans are at 1%.
Because it's better for public.
Yeah, they decide that it's better. So it's interesting. Now, when you translate that into their performance numbers and ratios, it's coming out all right. But you're right, Mark. I mean, if the oil economy goes south, the price of oil goes south, they could have some real problems. But that's to be determined, I think. But I'm sure they're aware of it and hedging their bets. That's what it comes down to. But it's really hard to peg the Bank of North Dakota one way or the other, because they give themselves all sorts of latitude as to what sort of loans they make. I'm always surprised by their approach. And what's most interesting is that they're very quick on their feet to respond to changing circumstances. And I think that's one attribute which is really important. They have a very responsive system in place, so that when there are floods on the Red River, on the Missouri River like last year, they step in and immediately issue lines of credit to both city governments as well as to businesses, so that they can get through it rather quickly. And Bank of North Dakota is funding them until FEMA kicks in, which is typically after reconstruction happens. So it's very interesting how flexible their approach is, which is one aspect to a more locally type owned bank, which is more responsive to people's needs. And we haven't discussed that yet, but I wanted to bring that in. So,
You've packed a lot into your question. So
Yeah, sorry, I was thinking a lot what you guys were talking.
I mean, a lot of the difference is going to be how very different assumptions of our starting points. And sometimes I think it's important to take a step back and say, what are our fundamental either beliefs we've come to accept, impressions on how the world works, impressions on how markets work, that reflect what we get to. And I think we need to have more debates about that, because I think otherwise we talk past each other. And so to some extent I would say and again, this is maybe a reflection of having spent too much time in and around government. I am not convinced that either the government at the federal level or at the local level reflects a common good. So I'm far more skeptical. So I don't really, I mean, if there's a sense of what's the choice on the table, and there's not a choice on the table, the choice on the table of here's a government that equally cares about everybody and takes care of everybody and is honest, and I don't actually see that as a realistic choice, because that's not in this country. So the question is, what are of all the bad decisions, all the bad choices on the table, what's the least bad? I will say Scandinavia manages a size of government that is larger because they have a more homogeneous population, they have a greater degree of trust and social cohesion.
That's correlated to having a lesser degree of wealth inequality.
And I will say correlation is not causality.
Well, exactly.
So
but
we don't really know what causes what in these instances. I would say, however, and I would love for America to get to the level of trust and social cohesion they have in Scandinavia. I would just say we are simply not there yet. Mm-hmm. You take, what was it last year, where members of the city council here were buying big SUVs and stuff. That would get the premier of Norway fired. I mean, the level of what they will put up with their government they will shame you endlessly. Here it's just another day in Washington. So unfortunately, we have all greatly lowered our expectations of what we think we should get from government, and we don't hold that accountable. So I quite frankly, I don't think you could reimpose a Scandinavian system. I will also say there's a lot of things that are very different. For instance, our tax system is more progressive than that in Scandinavia. The middle class pays the taxes in Scandinavia. So they tax corporations at a lower rate in Scandinavia. We tax corporate taxes, both the rates and amount as a percentage of corporation are higher here than they are in Scandinavia.
Well,
So
the
there
real
are very
crux of
major.
my question is what is this third way that you're talking about?
The third way, and that's fair. That's fair, but I do think it's important to unpack assumptions. That said, the third way that I'm talking about is having either like a cooperative or mutual where citizens come together, those citizens who choose to want to come together, who have saved, like, for instance, you have a mutual bank where the owners of the banks are the members. That's how a cooperative works necessarily. You pay in your savings, the bank would have a small community that comes together and decides, okay, well, let's go through the loan applications. In many ways, what I would say, and maybe I'm channeling this because I'm in a Quaker meeting hall, the way the Quakers work, or the way that even Mormons work in terms of when they come together and pool their community resources. But the point with that is it's always done on a community level where there's a consensual agreement to it. You choose to put your money in it. The Bank of North Dakota if you're a citizen of North Dakota, your taxes are paid to the state puts the money there. And of course, it's certainly an open question, what do you do with that flow of money? Again, I think that North Dakota is in a unique situation because they're running surpluses.
Are you describing credit unions?
Yeah, that was.
Your third way is a credit union.
No, not necessarily, because credit unions have grown beyond what they are. Almost anybody can. Credit unions have lost. In my opinion, credit unions have lost what they once were. And so and I also want to say, my third way is not ahead of time to predetermine what the outcome is. My third way is to let 1,000 flowers blossom, and let's figure out which opportunities work. If you do this, the Bank of North Dakota is a monopoly. There is one charter that's given. I'm against monopoly. I'm against deciding that this group gets an exclusive privilege that nobody else does. I per se am always against that. So,
I'm not against a monopoly if that monopoly is to function in the interest of the public. Because some things are bigger than what a small group of people coming together can pay for. And we have to be able to take care of everybody. What you're talking about is the people that have the money can put that money together and use it the way they want. And that doesn't take care of the many people that don't have the money.
If you're talking about taking care of everybody in terms of providing a safety net and welfare, pay for that, raise taxes, and pay for it. If you believe in we taking care of our brothers and sisters, you raise the money transparently and honestly.
That's what a public bank
does. Those are hidden costs. Why would you borrow? What's the difference between, let's say that you have run on hard times, you need a place to live.
What's the hidden cost?
What's the hidden cost is that in financing, I've borrowed some money from somebody else, I've hidden the risk that this money is going to be paid back. Here, let's take a difference between we've done in our mortgage market. Okay. We know there's a variety of reasons why somebody might not be able to become a homeowner. You might not have the income, you might not be able to save to get a down payment, the interest rate might be too high. Our policies at the federal level have decided that the way we're going to address homeownership is to try to lower your interest rate. But when you do that with hiding the credit risk, whereas if I gave you a down payment assistance, which is on budget, I spend the money, I'm honest about it, I'm transparent about it. Whereas again, I don't want to belabor the point because it's all throughout our mortgage market where we were promised all of these things would make us money and not cost a dime, and now they've dug us a very big hole that have interested just lining people's pockets. And so some of this is a skepticism of how this would actually work. I don't see the mechanisms in place in North Dakota. I don't see the mechanisms in the District of Columbia or at the federal government to assure me that this agency will actually act in the public interest. And so, again, it depends. I'm just fairly skeptical because I do not see a track record of putting those measures of accountability there. And so for me, I think you need a mix. And I would say a wonderful book published 40 years ago by a political scientist at Harvard was called Exit, Voice, and Loyalty. And what he talks about is the combining of you exercising your voice in the community, but you retain the option of leaving that because when you think you're being oppressed or you're being screwed, basically, that you have other alternatives. And if it's a public bank that takes my money and makes me be part of it, that's what I'm saying is, to me, the principle should be that this is voluntary and consensual. And maybe we differ on what we define as consent. But I think having my money shoved into the pockets of large financial institutions on Wall Street is not consent. And I think my tax dollars being used to fund the North, if I lived in North Dakota, my tax dollars being used for that is not consent. So some of this, again, is...
Will you speak from a position of privilege?
I feel like we need to allow other people, I'm sorry to cut off the discussion, but I just feel like we need to move on to more questions.
Can I talk directly to the role of monopoly, just real quick?
Just very quickly.
Real quick, and that is that a monopoly has been given to private bankers to issue loans. They own, that's a monopoly.
Which, again, I don't agree with. So we're not...
I understand. I understand. And public banking is simply a way for the people to take back the credit generating capacity to use for their own needs. And so if anyone here is against a monopoly, it's all more reason to break it up a little bit, or at least create an alternative, and have tax revenues be, instead of placed in a private banking monopoly, into a public bank which has more accountability to the community.
Thank you. Next question.
Great, yeah, I love the debate, and I think we kind of reached agreement at the end there. We all would support, let's experiment at the local and state level on the banking. And I'd like to ask, what has been the experience historically with public banking in the United States? Clearly there must have been other initiatives. You know, what's worked, what hasn't historically, and what are some of the major blocks that keep us to have only one in the whole country?
Sure. So during colonial times, there were a number of different land banks. Land banks were simply a mechanism for people to monetize future crops. Okay, so they basically issued loans to the farmers, and the farmers spent it in order to obtain what they needed in order to produce the crop, and then as a result, money was circulated in the community. Now, one of the most successful land banks was started by the Quakers in Philadelphia. There were a number of different community-type banks. We call them public banks, but obviously these weren't state-owned. This was colonial times. But the most successful ones were in New Jersey, Maryland, and Philadelphia area. Largely in Philadelphia, it was predominant with the Quakers. And if you go back to your history, if you remember all the different currency acts that happened in the 1750s and 60s, those were currency acts by the King of England that were put into place in order to basically get a piece of the action. People were very wealthy here because they defined wealth as their productive capacity. The money that was issued was simply scrip. And as scrip, there was no value in the money itself. It was ink on paper. Ben Franklin printed lots of it. Okay, but it facilitated economic transactions. The currency laws that were put in place taxed the people in a different type of currency, gold-based, which was the king's currency. Hence, we had the Tea Party, which was a revolt against the taxes being put in place that were to be paid with a currency that the people did not have. We forget that piece of it. We think it's just raising taxes, but the currency that had to be paid was a gold-based currency which people did not have. If they couldn't pay it, what happened? Their assets were seized. And so that was the historical background. If you look at history, a lot of the currency laws were put in place in order to favor the monopoly of the day, which was the king and his friends. Okay, and so we're trying to get away from that. One of the reasons why there's only been one public bank in the United States. There's actually two. There's the Chickasaw Bank in North Dakota. It's the nation of the Chickasaw tribe. It is a retail bank. It does have FDIC insurance, what Bank of North Dakota does not have. But it's in place to serve the needs of that nation of the Chickasaw people. I love that. I think it's great. And I think we all have communities which we need to further our interests, and a public bank can do that. I think it's the media. I think it's entrenched powers. I think it's a bias in our culture against having public institutions which are well run and serve the needs of the public, and in this case would break up the monopoly.
Okay, next question.
I'm interested in the idea of alternatives to these two. And Mark from Cato, I hear you saying that you would like to see private banking without bailouts, which I think a lot of people would like to see. There also seems to be a lot of consensus that bailouts, when they're necessary and not provided, the consequences are very severe. So we would like to see private banking without the need for bailouts. Do you think that we could move closer to that by reinstating, or could have by retaining the Glass-Steagall Act?
Let me start with, I mean, I think that there's still a fair amount of debate whether, whether if we had done the bailouts in question in, say, 2008, what would our economy have been? I mean, so, we let Lehman fail. Now, I'm not I know a lot of people will spin it that Lehman was the cause of the financial crisis. I don't think that that's true. I think when we bailed out Bear Stearns, there's lots of evidence where people went to Lehman and said, you're in bad shape, let me buy you. And Lehman said, I don't really like your price, I'm going to get a government bailout, so why should I negotiate with you? And so we created the expectation. I will also note we've had other instances. I mean, in the 80s, we let Drexel Berman, another big investment bank, go out of business without a bailout. During the financial crisis, we did not bail out WAMU, for instance, which is the largest savings and loan in the country, largest savings and loan failure in history. I do not see that as having been destructive of the economy. So what I would say is, first, it's an open question whether we'd be in a whole lot worse shape. I don't buy the fact that the TARP saved us from going back and living in caves or Great Depression Part 2. It's an open question. I think I can be convinced of it, but again, I just don't think the evidence is there.
It'd be a dangerous experiment.
They're all dangerous experiments. I mean, I think what we did was a dangerous experiment. So again, I put it this way: we had a massive housing bubble. It's not clear to me that if you had bailed out Lehman that somehow 2 million construction workers would have not lost their jobs. Because the fact is, on a very fundamental level, we built far more housing in places like Las Vegas and Phoenix than we want to live in. So you have a boom and bust, those jobs go away. And so if we had bailed out Lehman, I think it's hard for me to believe we would still have not put 2 million construction workers out of work. So that to me is, how much worse could it have been? It was pretty bad. So it still is pretty bad. So some of it would be, and again, I should note, before the 80s, before 1984, with the bailout of continental Illinois, it was not recognized policy that we bailed out banks. It was recognized policy that we let them fail. So I would say, within my lifetime at least, we were in a world where we did not do bailouts. And if so this is a relatively recent phenomenon, I would say, to some extent. And so how do you get back to that world? How do you establish credibility that you're not going to bail out these institutions? I think it's let me start from the premise of, my principle is, if you have access to federal deposit insurance, we should be able to place whatever.
Can you say yes or no first and then go on from there?
Okay, I'll give you the rest. No, I'm not a fan of Glass-Steagall, and this is why. And the why leaves a maybe to it. So the why is that, as a general premise, if we provide you deposit insurance, I think it's appropriate to place restrictions upon you that minimize the risk you would place a deposit insurance fund. As a general premise, that's where I start from. I do not believe the empirical evidence has convinced me that had we had Glass-Steagall in place, that it would have made a difference. Because you look at Bear Stearns, you look at Lehman, they weren't commercial banks, they were standalone investment banks. Certainly Fannie Mae was a monoline. Wachovia and WAMU, Wachovia particularly, who did have an investment arm, all the problems with Wachovia came from the mortgage portfolio. So I'm just hard-pressed to look at any of the examples of large banks that actually failed and see where Glass-Steagall would have made a difference. If you want to focus on something that made a change, 1994, the Regal-Neal Interstate Banking Act, that's what led to the concentration. You removed the restrictions on interstate banking. If you go back and look, and I'm happy to actually send you a chart and the numbers from FDIC, the large increase in concentration in banking that happened before the crisis occurred between Regal-Neal in 94 and Glass-Steagall, and Graham reached Bliley in 99 and repealed Glass-Steagall. So all that concentration was beforehand.
I hate to cut this off, but we have a few more people who want to ask questions, so I just want to try to get everybody's question on the table.
My question is for Mark with the C. The question of return, rate of return on taxpayer funds. You put the money into the public bank as opposed to the private bank. The private bank takes and lends the money in Africa and gives us a rate of return of X, and we give you the money and you lend it to a goat farmer in Vermont, and he gives us a return, the public bank say, and they give us a rate of return of 0.5X. Does that take into account, when you're calculating that rate of return, the benefit to the locals that occurs? I mean, it seems to me that your proposal that it's important to help develop Africa is important. But that seems to be, once again, there's something where transparency disappears. But if you were to lend it, that would tend to increase the benefit to the local economy, the local society, as opposed to doing a non-transparent benefit to a thing. Is there any way that you can quantify that return?
Well, so just to be clear, using Bank of North Dakota, they don't lend outside of their state.
Well, I'm just,
I know, but they're very, very clear that the money is, the credit capacity is used to fund the people in North Dakota. So it does not leave the borders, unless, there are a few instances, like I explained, where you've got an out-of-state company building something in the state of North Dakota. We've got all these economic measurements, rate of return or return on equity, which they use, and that's just standard to use that. There are other indicators you can measure and use that are separate from our typical transaction measurement type indicators, or how much money is is exchanged between people. But that's kind of beyond scope. I mean, we don't. The Bank of North Dakota does not go there. You could set up a public bank that does go there and measures the health and welfare of the community. And so you have economic factors as well as other factors. If you introduce local currency into the equation, that's one way to measure it, particularly if it's electronic currency, because then you have currency being exchanged. You can measure that, and that's another economic indicator above and beyond your return on equity or whatever it may be. But that's way downstream. We're not there yet.
If I can make a quick point.
Yeah.
It doesn't necessarily have to be the nature of public banks, but I think if you look at the Bank of North Dakota, you look at the Landesbanks in Germany, you look at the savings associations in Spain, they do tend to have the commonality that the borrowers and savers are all sort of in the same geographic community.
Right.
And one can see that as a benefit. I also raise the question of, it's not clear to me that the likelihood of the same group of people who are saving are always necessarily going to be the people who are most in need of borrowing. And so, I would make the argument, I appreciate that having that money leave North Dakota and go to the goat farmers in Africa might lessen the borrowing availabilities in North Dakota, but I would argue that the borrowing needs of that goat farmer in Africa are far greater. And I would argue that maybe they're small, but the benefits of helping that goat farmer in Africa develop will accrue to all of us. I think this should be emphasized. Growing these links between other countries is a plus for all of us. I'm not going to say that people don't lose with trade, but I do think us engaging and helping other countries develop is a net positive in the long run for all of us.
I have a sense that there's some actual consensus in this room around the concept of community. And I'm trying to imagine how a Wells Fargo and a public bank might work. I was recently up in New York, where they have engaged in participatory budgeting, where in 4 council members' districts, in East Harlem, 2 in Brooklyn, 1 in Far Rockaway, the people actually came together to decide how a portion of the capital budget would be spent for their council members. To me, this is helping a community function. They actually had all kinds of proposals for how this money could be spent, and then they vetted it to understand whether it was feasible. They actually talked to the relevant state agencies about whether it would be feasible. And in the end, the people came and voted for which projects would actually be funded. Now, to me, this is creation of community. One of the interesting things is that people who'd never come out to public meetings before came out, they got involved. Young black guys from Harlem actually were getting involved in a decision about how money would be spent. This is creating community. I can imagine that some modification of this could be used in a public bank here in DC. So we have all of this capital that's locked up in our banks. They're not loaning it. We know the people in the 7th and 8th wards aren't getting a chunk of this. We know that there's a huge need for jobs. We know that there are small businesses that could be created. If people could come together and talk about what the needs are in the 8th ward, in the 7th ward, in the 3rd ward, in the 5th ward, and then not decide on a specific loan, because I think that, as Ellen Brown says, you don't want to have a bank run to fail. You want it to succeed. That the loans have to be wisely made. But what category of needs should be met? How this pie should be divided up in order to actually meet the needs of the people of the District of Columbia? I can imagine with some creativity on our part, we could build this into the concept of a public bank. I have a hard time thinking about how that could be built into Wells Fargo. So I'm sort of put this out, and I'd like maybe Mark first, and I understand the answers have to be kept short.
Yeah, real briefly. So, having worked for IBM, I understand systems and what's happened with loan origination. One of the things that's happened is that it's all been codified, so you have a screen that people make applications on, and you completely take out the human element, as well as more subjective evaluation of whether or not something's a good idea. So you end up actually creating more risk for the bank by doing that. And sure, there's all sorts of credit scoring and other things you can do to minimize risk. But the fact of the matter is that we've come up with this rigid, inflexible approach to lending money, and that's a real problem. And that's one of the reasons why banks, large Wall Street banks, typically do not lend as much money to small businesses as they used to. It's really declined. It's picked up in the last couple of quarters, but they've put in place these inflexible ways to make it happen. Whereas a community bank, it's you sit across the table from somebody, look at them in the eye, you know their history, you know their reputation. It's much easier to make an evaluation that way. So that ties in with what you're talking about, but it's an important interjecting the human element to the decision-making process, whether it's loan origination or how what the profile of the loan portfolio looks like, is really important. Okay, so.
First, I'd say, I don't know if you've really looked into the concept of CDFIs, Community Development Financial Institutions, but that is something in federal law that to try to mirror some of that. So not going into much detail, because I've got a couple other things I want to say in a very short amount of time, but look into the CDFI concept. One, I would say I want to agree with all the descriptive things that Mark just said about our finance system, but I would argue that much of that has been driven by Washington. For instance, the securitization chain. We have moved away from an old style system. I've had 5 mortgages, including refinances, never once met the banker. And I do think we need to go back to a system where that's far more driven. So to some extent, I would again say it's not necessarily the choice between Wells Fargo. It's also the choice between the local community bank is an option. But again, some of these things, the capital standards that banks have, drive them away from small business lending and drive them towards securitized mortgages. And you've actually seen that with the Bank of North Dakota, where they've started to hold mortgage-backed securities for a while. So this is not, I would emphasize, this is not a market outcome. This is a regulatory outcome driven by the qualifications and standards and capital and everything else that's driven by. And it's too much detail to go over here, but I'm happy to give people more detail later if they're interested. But this is not the outcome of the market.
I think Ruth just put out, really addressed what Mark Cato, can I call you Mark Cato because there are 2 Marks here?
Mark with the K, Mark with the C.
I'm sorry. And you raise an important issue about how do you hold, let's say, a public bank accountable to, let's say, its charter, its dedication to public good. I think there has to be mechanisms, but I would say that the private sector, in principle, is always less accountable than the public sector. I don't want to privatize stuff, because at least the public sector, we have the potential to hold it accountable. The problem is, getting back to DC, Wilson Building is corporate occupied territory, okay? The politicians are largely bought and paid for by the big corporate sector. Their agenda is guided by the federal city council in large part. If you go to their website, you'll see Frank Keating, the former governor of Oklahoma, Republican, is the president of the federal city council. The guy from, from Washington Post sits on the leadership. They're setting the agenda. Wells Fargo was mentioned. First questioner mentioned Wells Fargo. Okay, a large, $100 million is put into Wells Fargo from our taxpayers' money now, and we found out that Wells Fargo holds interest in a prison, a private prison, that's housing the victims of the drug war east of the river, okay? So this is the reality in D.C. We have the highest income inequality in the nation compared to 50 states, to virtually every city. Half black children live in poverty. We got to do something different. We can't trust them. And again, the difference is we got to increase the commons. We have to expand the commons. That is public control and management over our own resources. The other way hasn't worked. And that's why I see the public bank, we can have different views about the details, but that's why I see the public bank being an opportunity, let's say put it as an experiment, to try something different and put our billions of dollars of revenue in and then leverage it finally. I'm an environmental scientist. And I raised this, by the way, last time I ran for city council because an economist, labor economist, suggested this is a good idea, a public bank. I'm concerned about the threat of climate catastrophe. So we need to have an approach that addresses the economic crisis and the climate crisis. And I think the public bank could be a mechanism for a Green New Deal. Just like we had a New Deal in the 30s, this is a different quality. So I said a lot, but maybe you can bounce.
Let me start with, again, I don't see the private bank option that's listed here as a market. I see it as a mixed economy. So I think our options are broadly three. We have a completely state sector, a corporatist sector, or a free sector. And we're not in the free sector. I'm not going to convince you today, but I would ask that you keep an open mind and accept that there are a lot of people of goodwill who share some of the same issues. I mean, we at Cato had a conference recently on ending the drug war. I think California, for instance, borders on a prison state. So many of these things, in my view, do not come from the market sector. But my point is that it's accountability in the question, and I'm not going to convince you today, but I would say to think about it. I feel like that if I don't like Coca-Cola, I can stop drinking it. I feel like if I don't like Wells Fargo, I can stop doing business there. Now, I can move to Virginia, I can move to Maryland, I can move to Canada, but all these things are very costly to me. So what I would say is absolutely agree that you need to increase participation in government. We need to make government more accountable. All that I agree with, but I would also say I think you need to reserve the opportunity to say, I don't want to deal with this. I don't want to be part of this. I don't want that service. I don't want this service. So what I would say, I think you need both. And so I think quite often government is stuck with, this is the deal I get, take it or leave it. This is what everybody wants. We all have different priorities, different preferences on what we want in terms of public services. And so I again think that, to me, I think markets are far more accountable than government. I think the evidence for that, in my opinion, is overwhelming. I respect that you see it differently. But I would say, if somebody could demonstrate to me empirically, as an empirical matter, that government is more accountable, I would certainly change my mind. But again, I think the evidence I've looked at over a lifetime, and I will say, I started out, I spent my years in college interning, summering for PERG. I started out very far left, and it's just, I've come to my own conclusions, don't have to accept them, but I've come to my own conclusions that the spread of markets has been the greatest force for reducing poverty in the history of the world. And I think it's done far more than anything else. So this is not an issue of, screw the banks in my opinion. This is an issue of making people accountable. I'm more mad and personally at the politicians who took my money and gave it to the banks. I remind you, Wells Fargo actually said they didn't want the money. And Mr. Hank Paulson sat across the table and said, you will take this or basically I will make your life hell. So again, the question is, absolutely, we should hold all of our politicians accountable. I think it's incredibly unfortunate that the parties we have are simply interchangeable fronts for different aspects of special interest in corporate America. So one, I think we need to look at third-party politics as an opportunity. I think the system here is absolutely broken. And I do want to comment, I mean, I think this is the first thing we need to do and continue to do is to talk about these issues, because I don't think necessarily we all have the answers.
The question that came to me when I'm hearing this discussion, and particularly when Mark from the public bank side was giving the example of the North Dakota Bank bringing in a company from outside of North Dakota so that it could bring jobs and whatever products to the people in North Dakota. And that raises the issue to me and the question from me as to a common language among many state constitutions are that you are precluded from using public funds for a private purpose.
Right.
And so when our local government, for instance, decided that it wanted to enter into development agreements to assist a mall to locate in our jurisdiction and to perform certain services to not only enable the mall to locate in our jurisdiction as opposed to another jurisdiction, but also to enhance the likelihood that a certain group of automobile dealerships would also benefit from this arrangement, these development agreements, and therefore would locate nearby. So as to prevail in lawsuits challenging whether this was use of public funds for a private purpose, the argument that prevailed was that, well, we're going to get sales tax dollars and there's going to be a lot of benefit to the community by creating jobs and et cetera, et cetera, et cetera. Now, the public, those types of things happen all over the country and they're controversial and people are on both sides of it. In our instance, because of that controversy, a group of citizens started a referendum movement and they got the issue on the ballot. So the participation of the community was, here we have the ability to challenge that decision to use public monies, the tax revenues, and the mechanism is the detail we don't have to address. But in any event, it went to the public and they got it on the ballot and we voted for it. When I'm hearing a lot of what you're talking about with the public bank, that raises the issue to me. You've got a board of directors who are going to be the politicians who made this decision to enter the development agreement, and you had the public with a vehicle by referendum to challenge that.
Right.
And a public bank, what's going to be the vehicle by which the community can say, I don't know that what you've decided is necessarily in the public good and we want to challenge it.
This has been litigated, and the specific issue is whether the state can lend its credit. In many state constitutions, that's prohibited. And so that's true also with North Dakota. But the issue is, or the way they address this is, the Bank of North Dakota is completely separate from the state. It is not a government institution. It is a state chartered bank. It is 100% owned by the state, but it is a completely separate institution, which, because it's a banking institution, it has the ability to create credit and lend that. Okay? So it's not the state lending its credit, it's this bank which is lending its credit. That went to the U.S. Supreme Court. It's been litigated. There's no issue with regards to that. There is an issue with regards to what you were talking about, more specifically, what happens if the people are not happy with how it's being lent? You know, and so I think that there should be a opportunity for a very participatory approach to defining the loan programs. That's the key to the kingdom. That the loan programs are the heart and soul of the bank. You know, those are the priorities of the people, and it reflects the values of the people. Okay? So if you have a democratic approach to how those loan programs are defined and the lending policy, then you solve that problem. So that's all I can say about that. But there are different ways to address that. North Dakota has a pretty open, transparent process. Doesn't have that many people involved in it, but it is pretty open. But other states could have a slightly different process, encouraging more involvement.
Okay, I would like to just thank both of our participants for taking the time. And thank you all for coming.